Hey, Steve Saretsky here. As always, this Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask is that you hit thumbs up, subscribe. I appreciate the support. As always, if you have any questions, comments, put those below and we'll banter back and forth. That's really what makes the show. Couple things from a statistical data standpoint. The Canadian Real Estate Association released their April data, and if we start to unpack some of that, we'll go through that, some of the Canadian data, BC data, and then what's happening in the Canadian bond market, or really the bond market in general, what that really means moving forward. Obviously, there's a lot of people out there that don't necessarily understand the impacts of the bond market and what that means for mortgage rates, etc., and obviously house prices. So we'll get into some of those more details, but first off, looking from the data standpoint, Canadian real estate prices in April on a year-over-year basis declined 11%. That's the average sales price declined 11% nationally. Again, obviously a lot of that slowdown is coming from Ontario, particularly since they really had peak prices about a year ago. And if you want to, smooth that out, so the average sales price is down 11%. I don't think you can sort of sweep that under the rug and try to make excuses for that. I think it's certainly a very important metric in the grand scheme of things. But if you want to say, well, my market's doing this or that, you can break it down into using the Teranet benchmark, which is obviously much more smooth out. I would argue that it's a delayed component, but they have national home prices up 5% on a year-over-year basis. But if you take that same Teranet HPI, it's actually down, I believe, 1.7% from their peak, which they're calling August 2017. So yeah, and there's some important metrics, right? I mean, I think looking at that Teranet, right, down 1.7% from August. I think they noticed the slowest year-over-year growth. One of the slowest year-over-year growth since they've started that methodology 20 years ago. So you're starting to see some movements there. Obviously, national home sales, those were down 16% on a year-over-year basis in Canada. So just looking at that, right, you have the national home sales declining, national average sales price declining. I don't think you can necessarily sweep that under the rug, as I mentioned. That has larger implications moving forward on an economy which is heavily dependent on real estate, heavily dependent on credit growth, which we've seen slide to a 20-year low for the first quarter of 2018. And that really is a result of the mortgage stress test, I think, and ultimately just pulling a lot of this demand forward. You've had a lot of policy measures put in place, obviously higher interest rates, which we'll get into. So this is going to have much broader implications moving forward. If you unpack that, looking at the province of BC, obviously we've had, led by Vancouver, the most obscene price growth of any other province in Canada. The average sales price has actually gone flat on a year-over-year basis, registering 0% growth. It's actually still down from the 2016 peak, which is really just a change of the composition, going from less or fewer detached home sales to more condo sales. That's how you've seen that average sales price sort of peak out. But again, 0% price growth on a year-over-year basis for the month of April. BC home sales fell to a 5-year low. Again, this just has bigger implications. BC, the real estate sector in BC makes up roughly about 25% of GDP. That's like the FIRE sector, finance, insurance, and real estate. So anytime you have a 5-year low in sales, that's going to start to matter moving forward. Obviously, you have the NDP government coming out earlier this week saying that they are planning on moving forward with a speculation tax. Despite whatever the data might show, they remain intent on moving forward with that. And of course, you have higher interest rates, which are now starting to creep in. So this is all going to matter, and we're starting to see that. It's interesting to see, coming out with the Canadian Real Estate Association's report. Obviously, the chief economist took a stab at the mortgage stress test. I'm seeing a lot of realtors and mortgage brokers start to say this stress test is stupid. People should just borrow more. They really don't understand the implications of where we are in the cycle. what the implications mean of really overextending yourself and building up that debt. You can only build up that debt for so long. And when you're this late in an expansion, you know, going on 10 years here now without a recession, this late in the economic cycle, not only the real estate cycle, but at some point here, you know, the second longest expansion, you're going to have a recession. So they need to start pulling in that debt. They need more responsible lending for people when evidently the unemployment rate starts to rise. That is going to happen at some point. Obviously, nobody knows when to pinpoint it. But to say that the mortgage stress test is irresponsible when you've artificially suppressed interest rates for 10 years, which has resulted in home prices in BC basically doubling since 2008. You need to put in some measures here to align those with incomes that obviously have not been able to keep up. And it's funny because nobody complains. They say, well, I don't want the government in the housing market. And I agree. I'm more of a proponent of free markets. But if you actually look at it, a lot of people don't really understand why Canadian real estate actually, for the most part, missed the Great Recession of 2008, 2009. You had a small dip and it was right back up. As I mentioned, there was policies put in place to support the housing market by the government. So nobody intervened. Nobody complained then when the government intervened to support house prices. But of course now when they're taking away the punch bowl with a mortgage stress test and demand side policies such as foreign buyers taxes, etc., people are all of a sudden up in arms. But I would argue that there really is no free market. You know, the Canadian government supported the Canadian banks with $114 billion worth of stimulus in 2008, 2009. That was basically CMHC buying up bad mortgages on banks' book and packaging them into mortgage-backed securities and offloading them. The CMHC basically absorbed a lot of these poor mortgages onto their books. They took them off the bank's balance sheet, and that provides liquidity into the market. Of course, they went down, hammered interest rates into the floor, 40-year amortizations. That's what you call government interfering with the housing market to basically support home prices. And again, so I don't really, people that make that argument for the stress test I think is ridiculous. They don't really understand the history of Canadian real estate. Which ultimately brings us to the bond market here, which is pretty much out of control of central banks. And I would argue that this is probably not what the Bank of Canada wants to see. I'm trying to take a very slow and cautious pace moving forward. But that 5-year government bond, which is tied to the 5-year fixed mortgage rate, has been surging, particularly in the last couple weeks. From a year-over-year perspective, you have to remember that the 5-year Canada bond yield was yielding 0.9% in May of 2017. 0.9%. It has since jumped now to earlier this week, jumping to over 2.3%. So, I mean, that's a substantial move higher, and that's why we've seen 5-year fixed rates going from about 2.5% last year to today at about 3.5%. And those costs look to continue to move higher. You can see it in the bond market as a whole. As I mentioned, the Canadian bond market is largely impacted by what the United States is doing. Their U.S. 10-year Treasury yield climbed. It just passed a very important technical level, which is 3.05%. If you watch or listen, there's a good podcast called Macro Voices. They bring on the best guests really in the finance world. That was a key technical point that they talked about, was the 10-year yield in the U.S. Treasury market eclipsing 3.05%. It did that. It actually clipped 3.10 a couple days ago. And as a result, yeah, we've seen the yields spiking in the Canadian market, obviously higher interest rates on the 5-year fixed. And that's hugely important, right? We had that stress test benchmark move up 20 basis points last week. So each hike higher on these 5-year fixed is chipping away at people's borrowing power. So you're asking them to pay an ever higher house price when mortgages are becoming more and more expensive and you're chipping away at that borrowing power, which is, affordability levels are already stretched to a max. So that's why we're starting to see a slowdown. I can say from a granular level here in Vancouver, we're starting to see some reductions on 2-bedroom condo prices. That's not to say prices are coming down, but optimistic sellers are starting to say they're starting to see people coming in offering $10,000, $20,000, $30,000 off the asking price. There's no more multiple offers, and rarely in those 2-bedroom segments. 1 bedrooms, if it's a multiple offer, as opposed to getting 3 or 4 offers $50K over, maybe it's 1 or 2 and you get asking price. And so, yeah, it just feels like you've sort of turned that corner, and I think a lot of that has to do with that stress test and, of course, that bond market pushing ever higher. I think that's going to be important to watch moving forward. And, if I guess potentially as an advice or something, if you might be looking for to get a discount as a result of that 5-year fixed pushing higher and higher and the banks hiking those rates, they've actually made some changes to the variable rate mortgage market. They've actually gone prime minus 1%. I don't think they've ever done that in history. So they've done that. That's basically them competing for business. Again, that variable rate is pretty much tied to what the Bank of Canada does. So if you think the Bank of Canada isn't going to hike rates, then you probably would be wanting to go for the variable. But at the end of the day, nobody really knows what's going to happen with rates. There's so many factors that can get out of control. They just don't know how that all shapes up. But so yeah, I mean, if that's how you want to play, me personally, I feel like the Bank of Canada might get away with 1 more hike this year, maybe 2. I don't see that variable moving much higher, but don't take that as investment advice. I think you have to make that decision for yourself. Interesting tidbit in that bond market. I believe it was the Canada 10-year, 30-year yields actually inverted, and that's generally an indicator of a potential recession looming. There's some good data on that. When those bond yields invert on the longer end, they tend to indicate potential recessions. And I was gaining some headlines in the news that Canada was one of the only G7 economies, I believe, that actually had their bond yields, the 10-30, invert. So we'll have to, again, that's very important. We'll keep an eye on that moving forward. That's pretty much all I got for this week. Again, if you have any questions, comments, put those below. Another little tidbit. I had people coming up to me, on the streets or emails, whatever the case it is, that are perhaps a little bit shy or think that I don't have time to work with them. I do take on a lot of clients. Still am taking on clients. So if you were looking for real estate services, the best way to do it is just email me at steve@stevesaretsky.com. Depending on where you're going, I don't just work in Vancouver. It really depends on the area and what you're looking for, etc. So you can shoot me an email there. That's the best way to get a hold of me. All right, I hope that helped. Take care.